Well, it's interesting to see on this Friday, especially all the volatility we've had. Markets are rallying on the heels of that June jobs report. Take a look at the numbers and what we had. The Labor Department reported that the U.S. economy added 287,000 jobs last month. There's your markets. Dow actually pushing highs right now. We're up 261, S&P, NASDAQ higher as well. But again, we beat expectations. 287,000 non-farm jobs added. And mostly this report was positive, but it also showed that wages remained stagnant, increasing to 0.1% in June. On top of that, the key number we always look at, that labor force participation rate, it's hovering near 38-year lows. That story continues. I want to bring in Lido Advisors President Jason Rotman, along with economist and University of Maryland business professor Peter Morici. Peter, that labor participation rate, it's stuck. It's stuck at that level, and it's not a good level.
No, it's not. And the jobs market is really not that robust. I mean, the 287 has to be seen in the context of the May number, which was only 11. Over the last 3 months, economic growth's been about 2.5%. That's what the Commerce Department will report in a couple of weeks. New jobs creation has been about 147,000. That's less than the first quarter and less than the last 3 years. Overall, we have been cycling down as we see more and more machines at the CVS and other places. We're simply not adding that many jobs, and as a consequence, wages aren't rising, and people who have not been participating in the labor market because they get a lot of government benefits don't see much gain in getting out there and looking for a job. And
what's so interesting, Jason, as you look at the market reaction today is that we have this right now, but over the longer term, there's just no growth story out there. And that's an economic story. It's almost like when you wake up and you think, oh, wait a minute, where am I? What's reality? Well, the reality is that the economy isn't doing so well.
Correct. So what I would add to that, which I agree with, is a couple points. Number one, just from a trader standpoint, this is starting to feel like market euphoria. And whenever it starts to feel euphoric, or in other words, irrational exuberance, if I may, that's the time to maybe get a little concerned that this rally is unsustainable.
But you're not saying that's right now, Jason.
Yeah.
I just want to clarify. You're not saying that now. Okay.
No, I don't think so.
I'm saying that it's getting there. We're not even above all-time highs yet. I think you're going to see a lot of cash on the sidelines looking to get in once it breaks all-time highs. Yeah. But I think at some point fairly soon, maybe even at the end of this year, maybe we get a Christmas rally that is the ultimate fade, where that's when you get out.
Well, but you know what, Peter,
really
that's going to be after the election, and I think that's the big question here, because you've got two candidates with very different tax plans that they're proposing. Peter, I mean, the election's got to factor into your thinking.
Well, right now, I think that the election creates an awful lot of uncertainty because they take us in two different directions, the two candidates. But if you're looking at the immediate outlook for stocks and its impact on the election, I think the immediate outlook for stocks is very favorable. I suspect that the second quarter profits reports are going to be pretty good. And when folks see that GDP number, while it's not gangbusters, it's not Ronald Reagan growth of 4.5% and 400,000 jobs a month, it is enough to keep profits moving up and to take us back to our all-time highs on the Dow, the S&P. So my feeling is we're going to have a July rally. It's going to be something we can enjoy. That will impact the election because it's going to make it tougher for Donald Trump to make his case.
What do you think? Jason, do you agree with that?
Listen, I agree. As I noted before the gentleman started speaking, I think we're going to continue to go higher, possibly throughout the rest of the year. The problem, bigger picture, briefly, is that there's $10 trillion of securities in the world with a negative yield. And whenever you see that, that means that the global market is not confident in the growth story, as you pointed out, Cheryl. So for a sustainable rally, that's not good news. But I think over the next few months, sure, we're going to break all-time highs.
All right. Well, gentlemen, we are seeing a nice rally today anyway, and certainly, with the unemployment number coming out today, I mean, you want to look at these numbers and find some good, and there's some good there, I think, Peter. But, I do want to end on a positive note. What portion of the economy, what sector do you like the best? And then, Jason, I'll go to you. Same question.
Sure.
Well, this portion of the economy I like is high-tech manufacturing, the stuff that uses a lot of intellectual property. I think it's going to do quite well. And I think we're going to see a lot of substitution of labor with capital over the next several years. So things like robotics, machine tools, and so forth, they're going to do quite well.
Sure. Not great for jobs, though. Jason, what do you say?
So I have a pick to click right here. That's TAL International Group. Briefly, they are one of the global leaders in container leasing. They lease containers to various companies that use, containers to ship stuff overseas. The key with TAL is that they are the ultimate definition of a beaten down stock that's not going out of business. And furthermore, 12.8% yield today. You buy it today, you sit and wait, you get 12.8% a year. I love that stock right now.
Jason, you had Peter Morici saying, wow, that's pretty
good. I like
that.
I like this is good. Jason, would you call me after the show and give me a few more of these?
Play together.
Hey.
Play together. We're going to go to commercial right now. Jason, Peter, guys, thank you very much for the commentary.
Sure.
Appreciate it.